Okay. Hello, everyone. Welcome to this webinar. Nice to see you all here. It's my pleasure to be again here. Hello, Annie. Hello, Adinda. Nice to see you, girls. Thank you. Okay, well, as you may know, this is another Beginner's Corner webinar. We have been discussing over the past couple of weeks what we call continuation figures and what we call reversal figures, right? Today we are going to talk about a couple of figures that I tend to consider out of classification, right? Non-conventional figures, I said, because they are not either trend reversals or trend continuation patterns, but they have different interpretations that we are going to attempt to explain today, right? Anyway, let's start placing the charts. And as you may see, we are going to start talking about channels, right? As you may know, a channel is a figure of high reliability, in fact, right, that is formed by two parallel trend lines, okay? Two parallel trend lines. One connects the price highs, the other connects the price lows, and in between there is a zone where price used to stay moving from one side to the other till it finally broke. Remember that no matter what we use to determine a top or bottom or support or resistance level, price will finally break that area, right? Sooner or later, the area will be broken. If not, trading will be something quite easy and quite boring because price will build up inside a certain range, and we only have to wait till the price to reach near one to go to the other, right? There is nothing unbreakable in the forex market, okay? Anyway, as you may see, both trend lines, both the upper and lower, act as support, right, on the resistance area for the price action. And as you may see, there are different kind of channels, but mostly every single one works the same way. And so let's take a look at each one, okay? As you may see, let's start with this, that this is an horizontal channel, right? It can be found either in an up or down trend, right? It doesn't mean a trend change of the previous trend, but a rest in the middle of the dominant one. They usually mean this lateral rest and a continuation of the previous dominant trend, okay? It's a very common and reliable figure, okay, meaning that usually price completes the figure and continues the price action after following. However, there is something that we may take into account. Despite the books said that tend to be continuation figures, I choose precisely this example because in this particular case, it has been a strong reversal pattern. That's why I tend to leave channels outside of the trend continuations or trend reversal formations, right? It's a very particular figure. As you may see in this particular case, we are talking about the euro-dollar when the pair reached 160.30 area back in 2008, right? The channel is formed by 1, 2, 3 minimums at the same level, okay? While in this particular case, we have just two highs at the same level. Yeah, we can consider this maybe a double roof formation also. What I'm seeing in the middle is like we have two valleys and not just one. That's why I'm not considering this a double roof, okay? More likely I was seeing a lateralization and rest in trend. As any kind of figure, okay, the moment of the break is very important. We need to see high volume, and as we said over the previous sessions, the high volume is easy to measure in the forex market, right? Considering the height of the candle that breaks the figure formation. In this particular case, as you may see, this candle is almost 3 times the average the euro-dollar move per day at that time, right? So, because keep that in mind, pairs tend to move a certain couple of pips average per day, right? But that changes. Over the past few years, euro has been moving up to this to 2007. Before that, an average of 80 pips a day, right? Then we jumped to a couple of years when the pair was in between an intraday range of 150 pips almost. Okay, and now we are slightly below that level, in between 100 and 120, right? But it has been so for a couple of years already. So keep that in mind when you consider this. It's not just the number of pips, it's the average of the latest one. I will consider the past 3 months minimum, okay? Anyway, and coming back to our example of channels, right? I have set an example of bearish channel, right? In the same case, we have 2 parallel lines, price finding top, right? In the upper descendant trend line, while bouncing higher from the lower descendant trend line, right? In this particular case, it's the euro-dollar daily chart. And finally, we are going to see, as you may see, sorry, I forgot to add, of course, the bearish channel defines its trend by itself, right? And usually a break of the opposite side tends to signal a trend reversal in the currency and the study, right? However, we are going to see a bit more a practical example, and we are going to take the bullish channel in pound, okay? Again, this one for itself is showing us the major trend, right? And it doesn't need a change of that trend until it's broke to the downside. Why? Because it's a bullish one. In this practical example we are about to see, right? I would like to say that channels are useful to trade because they show us certain points where we are expecting a determination and particular market reaction, right? We know, if you take a look at this channel, right? I draw this channel with 1, 2, 3 points, right? And when I drew these first 3 points, the ones that start the channel, right? I was already expecting price to stop around this area and start falling lower, right? Near this one, yeah, near this one. The fact is that we need to consider also that approaches in the bullish cases, right? Approaches to the base, right, may fail, as in this particular case, right, because of the strength of the dominant trend, right? So if you're going to trade whatever channel, whatever time frame, I choose this weekly because it's quite clear, but there are a lot of ones, and we can also see them in the orange channel. What I mean is, if you are trading the channel from the high, bullish channel, from the high to the low, right, don't set your target in the lower ascendant trend line. The pair will probably fail to catch it, will probably approach and resume its bullish trend, right? On the contrary, when it, in the case of the bullish one, again, when the price reaches the upper line, there's a good chance that even we see an acceleration, right, an attempt to break but failures of that. Anyway, back to this example. When drawn properly, it can assist us to identify areas of support and resistance, right, determined by the floor or the roof of the channel. And it's a very valuable tool because once a channel is defined, right, we can see several triggers inside it. First of all, right, trading with channels, whatever the time frame it is again, right, give us a strategy very limited and that grabs and puts all together the entry point, the stop loss, and the limit area. And those are the things that every single trade involves. We should not forget that we cannot determine just the entry point. When we have a trading plan, when we have a trading strategy, our own entry point should be also with our stop and our limit area, right? And in this particular case, the channel for itself is giving us, it has defined the entry point, stop losses, and the probable target area. Practically, let's say that once the price touches the bottom, right, in this case of an ascendant one, in this moment, or this one, or near, right, there are good chances we see price heading higher, right? So we can buy around those levels, aiming for an approach or a retest of the upper ascendant trend line, which is the roof of the channel, right? Of course, the stop loss should be placed below that trend line, and I have 2 different strategies to set myself. One, it will depend on the chart I'm trading. If I'm trading the 1 hour chart and I have an ascendant channel in there, I will not use the stop much more longer than 15 or 20 pips. Okay? Why? I tend to set my stop in a short average of the intraday range, right? Accordingly to the chart I'm trading. If I'm trading the daily chart, then maybe I would need to set my stop at least 60 pips or even 80 below the base of the channel, because we can see spikes. Like in this particular case, that's failure, okay, that's fail, okay, to break. We need to see the day closing outside the channel or a break, like in this case, with a strong volume to confirm the final break, right? So an intraday spike in the middle of the daily chart or the weekly chart, like in this case itself, right, could be long. In case of the weekly chart, I would stop loss maybe of around 200 or 300 pips, right? But if you measure the height of this particular channel is of around 1,000 pips, so the risk-reward ratio seems pretty much interesting, right? Another thing that you can do when trading inside channels and to filter the trading strategies, right, is drawing trend lines. I will approach a bit the chart, okay, closer, and we can see in here that once the price bounces from the bottom, how can I be sure the price will probably reach the high? Well, I can draw a descendant trend line, right, in the upcoming next days. Once the ascendant trend line is broken, right, that kind of break is confirming me that the price will probably continue to upside, okay? And I can do exactly the same in the opposite direction, okay? As the price reach the bottom, right? Reach the top, sorry. Reach the top. Sorry, I can draw the descendant trend line also in this particular case, right? And wait for the break to confirm, okay? This is one of the best ways to trade channels, to wait for confirmation. True, we are losing a big portion of the profit in this particular case if we draw trend lines, right? But, and even we can do this in smaller time frames, but this is sort of a strong filter, okay? That will filter the trade, that will confirm us and give us more accurate certainty that the price will reach our target, which is the other extreme of the channel, okay? I usually tend to do such thing as watching the channel in bigger time frames and attempting to trade them in one smaller one, okay? In this particular case, we are going to see those green circles, okay? Give me a second till I remove them, okay? Sorry. Okay, there we are. Back. Right. There we are. Sorry, I will draw the channel again, right? In this particular, as I was saying, what I tend to is to watch the channel, draw my channel in a bigger time frame, and when attempting to trade, move into a one smaller time frame. Why? Because it will be easier to determine the trend lines in this particular one, the expected breaking moment. I will not be missing so much of the profits, right? Like in this case, okay, I won't be missing that much, or in this particular one, okay? So in order to not losing our winnings, right, we recommend usually to use a trailing stop so as to reduce our risk and ensure the profits, okay? If we decide to get inside the channel when the price reaches the bottom, it's okay, right? We can place our stop, but we need a break of a trend line to confirm an upside continuation. And in that particular case, I will lift my stop loss and use a trailing stop, waiting for the reach of the top of the channel, okay? You can also see at the end, okay, how the pair, here we are at the end of the channel, right? How the price action failed to break higher, and we have a strong break to downside and even an acceleration gap in the middle with a continuation to downside, okay? If the price action tends to be this kind of behavior or something like this, right? The price attempts to reach the bottom of the channel and fails, right? Both are signals that the trend is maybe starting to be exhausted. Both are telling me that there is a good chance that if the price breaks below the base of the channel, we are going to see a strong reversal, okay? On the other hand, okay, if the pair on the study breaks to the upside the ascendant channel, right, that's just a sign of acceleration of the dominant trend, okay? And it's probable that we will see a strong continuation and strong development of that new trend for a long time. Meaning, if an ascendant channel is broken to the upside, there is little chance to see a sooner reversal. And on the contrary, if the ascendant channel, is broken to the downside, ascendant once broken to the downside, that is a strong signal of continuation of the dominant trend, and we are not likely going to see a reversal, okay? Anyway, I believe it's pretty simple, right? It's not something too much complicated. But I believe that it's very important to follow this kind of formations in the current Forex market. There are several technical formations that are not applicable to Forex market, but the challenge, I just find out that they're quite reliable figures to trade, okay, or at least set as the range in between a pair is trading and the dominant trend following that pair, right? As I was saying, the books tend to say that the break signal continuation, right? However, keep in mind that a break in the opposite direction is always probable, it's always possible, right? No matter what kind of channel we are looking, right? Breaks on the contrary direction are more likely, despite books don't consider that a break, okay? Keep that in mind when trading. In that case, it's better to discard the figure, okay? And move on and search for another kind of strategy or technical support for our trading. However, keep in mind that I know that trading strategies are based in indicators or in experts' advisors, in Fibonacci's, in kind of line studies, right? And we are not always seeing this kind of figures in the market. However, early detection of these figures may help us in our overall trading, because if we are in the middle of a bullish channel and we have a trading strategy that's giving us buying signals, then those buying signals will probably be much more profitable than if we have a selling one, right? As usual, we said the trend is your friend. Same happens in the middle of bearish trend. If our trading strategy suggests us to sell in the middle of a bearish channel, then that will be the case where the most profits are likely to have. Anyway, we are going to talk about another non-conventional figure, something that is really common, not only in the Forex market, but also in the stock market. Before starting with this, I will give you two warnings, okay? First warning is, charts are not always the same. I'm using a UK MetaTrader, right? If you're using a United States MetaTrader, or an Australian one, or a Japan one, right? Your candles would probably be different. Mostly when we talk about daily and weekly candles, or the 4 hours one also. We are going to see the same candles in 1 hour, 30 minutes, 50 minutes, right? In smaller time frames. So, whatever you learn in here, not just for me, but for any other expert, okay? Keep in mind that you need to test it in your charts and see how accurate the charts you are using are, okay, regarding that start time trading strategy or system or whatever. So what we are going to talk about now is about gaps, right? And the price opening in my candles may be quite different to your price openings, right? You need to understand the behavior of the pair in your chart, okay? That's the first warning. And the second warning I was about to give you is that the fact is that all these trading tools, all these figures within the market, even channels of gaps, right, have been developed for stocks market. Okay, all of these theories have been developed for stocks market, and we are applying them in Forex. So the case is that despite whatever you search on the internet and find, the theory that you may find, it's applicable to stocks in many cases, but there are exceptions when those theories can't be applied to the Forex market, okay? And we are going to see one right now. As I said, we are going to talk a bit about the gap, right? And so let's start talking about what gap means. And in fact, we can say a gap describes the circumstance of when a certain currency pair, right, opens at a higher price that it closed the previous session, or in the opposite, open at a lower at the bearish close, right? Meaning we see a small blank in the middle of the price action, right? I will enlarge it a bit, right? In this particular case, we are talking about the dollar position weekly chart. It's one of the most outrageous gaps, like the sign, so that's why I posted, because it's pretty clear to see, right? As you can see, the price closed on Friday around 16.50, right? And next week open around 15.17, right? If I'm not remember wrong, this one back in 2006 was due to a G7 meeting over the weekend, right? That's why I don't tend to lift Japanese yen trades open over the weekend. Whatever you want to trade now these days, the yen has changed a lot. But if you take a look at charts, you will see that we have heaps of gaps in the weekly charts, meaning we close here, we open there. We close it, yeah, we close it. But anyway, we open here, right? Close here, open here, yeah, there's still the gap. But if you take a look at the weekly chart, I believe that dollar Japanese yen is the one that posts more Sunday gaps than any other pair, okay? Anyway, sorry. As you see, it's blank in the middle of the chart, a hole, right? The price zone where we have no price action, right? And we can see them in the weekly charts, in the 15-minute charts, in several circumstances, and we are going to discuss how to take advantage of those several different circumstances, okay? We have different classifications for gaps, okay? I will start with this chart because it's my favorite one regarding gaps price action, okay? That is the pound weekly chart, okay? The first kind of gaps we have is what we call breakaway gaps, okay? We call it breakaway because it usually happens when price breaks through a critical level of a figure of, I don't know, a head and shoulders neck, and ascendant trend line, whatever, right? Usually, this kind of gap means we are at the beginning of an important movement, okay? And that this movement is just starting. Generally, this kind of breakup gaps are closed, at least in part, in what we can call a pullback, right? To the broken level, support, resistance, neckline, whatever. In this particular case, I was seeing this one in pound, right? As you may see, we have a Sunday opening of around 100 pips, right? And price action fill it, right? Price action managed to fill gap, right? After a couple of weeks, of course. And then resume its bearish trend. I will put the chart smaller again because if you take a look, you will see that we have this one, okay? But we also have this one right away, okay? This second one is what we call a continuation gap, okay? Or also called runaway gap. This runaway gap that usually took place in the middle of the trend, right? And probably because of an acceleration of the movement and a temporary lack of price. This kind of gaps, they show us that the trend is fully running, and the general rule says that they are never closed, okay? They are never filled. Although I don't particularly agree with that rule. Why? Because in Forex market, most of the gaps are filled. We are going to discuss different pairs and when they fill the gaps and how. But keep in mind that they are filled, okay? Maybe 1 or 2 years later, but they are filled. But when we have a continuation gap, there's a good chance the market will at least feel it partially, like in this particular case, that we see price action heading higher, but failing to reach the 77.17 level where it was past weekly close. Okay? In fact, pound has a gap all over the way, and if you take a look, we have one at the highs around 2, right? That never filled. So that's what I warned this about gaps. Anyway, and finally, the final case of gaps is what we call exhaustion gaps. Honestly, the exhaustion gaps, right, show us the end of a trend movement, okay? They are always filled and generally price passes them back, okay? And they usually represent a final surge of buying or selling power, right, before a major trend change. The fact is that it's very hard to see that kind of exhaustion gaps in the forex market. Those gaps are more typical of the stocks market, okay? And despite being highly profitable, this kind of exhaustion gaps, right? The fact is that it's pretty similar to the continuation one, okay? It looks just like this one. So we are in the middle of bearish trend. We see a continuation gap. How we determine whether it's a continuation, right, or an exhaustion gap? Honestly, I have not seen exhaustion gaps in the forex market. Or I haven't. I was hearing about the euro and New Zealand dollar to chart to look for an example. I could not find it. And I have been following the gaps in the forex market for many years. So, how do I determine it? Sorry, back to what my idea is. If this gap, okay, is a continuation one or exhaustion one. Honestly, what I tend to watch, right, and I will enlarge a bit the chart, sorry, is what I tend to watch, right, is price action in the opening. If we have a candle opening and price is unable to overcome previous candle close, like in this particular case, meaning we did not fill that, or we fill it and we did not overcome that 77.17 in this particular case. Yet, on contrary, we break or stand the slice below, right, that previous candle low, then that should be understood as a continuation gap and nothing like a reversal signal, okay? Another way to filter them is adding, a trend indicator like an ADX, okay? Or try to determine the dominant trend. In this particular case, the dominant trend is bearish, okay? So, if the dominant trend is bearish, if I have an exhaustion gap, to the upside, which we don't have too much examples of that, but if we have an exhaustion gap to the upside, right, then, well, yeah, I could sell because I'm sure that that's the end of the trend because it's contrary to the dominant trend. But honestly, it's not easy to see in the forex market, okay? Another way to filter that kind of exhaustion gap, okay, is using, divergences in MACD or in momentum indicator. You can add those two and see if you have any kind of divergence, right, to filter those. Anyway, while there are many different trading strategies involving gaps, I will give you right now a couple of tips, okay? When we are starting with the standing gaps, right? There are different kind of gaps we are seeing in the forex market daily. Let's go to daily charts and let's talk about the standing gap, okay? This was sort of the standing gap, right? This one. Okay, let's review this once more to the hourly chart, okay? That's what I usually do. Give me a second till I find the chart, okay? Okay, here we have one, okay? In the hourly chart, Sunday close, right, and Monday opening. We have gaps in here, right? What I tend to do with this kind of a standing gap, right, If you want to trade them, okay, trade them. You can buy at the price, hoping the price fills the gap, right? But my empirical experience says that price action should fill that gap at least in the first 3 hours. Okay? If the gap is not filled in the first 3 hours of trading after the Asian opening, then most likely is that we are going to see the price either falling on the gap, standing for God knows how long. Okay? It could take 1 day, 1 week, or 1 year to fill that gap. So, if you want to trade a standing gap, okay, buy and go for the each, right? But after 3 hours, you should be outside the market. See, in this particular case, next week, what happened, right? We have another standing gap, right? And we have 1, 2, and in the third candle, the price overcame and filled the gap. So that's my main strategy when I tend to trade standing gap. 3 hours rule. Don't stay in the market more than these 3 hours. If you stay longer, you are risking to this, right? Spending almost a full week in the negative side of the market, right? Unable to profit from that, right? So 3 hours is the particular rule. Also, there is different reactions regarding that and regarding the different currencies we trade, right? In the case of this standing up, right, while Canadian dollar and pound against dollar are harder to fill gaps, right? They hardly fill gaps, okay, than the opening one. Swiss franc against greenback again is one of the pairs that closes the gaps faster and with more accuracy. Meaning, if you have a standing gap in dollar Swiss franc, well, chances of that gap to being filled in the first 3 hours are above 90%. Okay, the 3 hours rule, of course, is right. On the contrary, if we are talking about Canadian dollar, chances of that gap being filled quickly and easily, okay, are less than 50%. So if you're going to trade, extend the gap because you see a strong movement in the market, right? Well, first take a look at Swifty, then at pound, and never ever take a look at Canadian dollar. Okay. Another thing that is really interesting and regarding this same subject, so the fact that Japanese yen tends to fill those gaps. Okay, but it tends to extend its slide. Meaning, if we have like in this cases, right, we see that the opening was around 142, right? And the price action rose 60 pips to 42.70, then entering sideways stage, and then finally break lower, right? Well, the fact is that after that we see the lateralization. The fact is that Japanese yen tends to break in the first couple of hours this first opening price. Meaning, if we are talking about Japanese yen, we'll be probably sliding before this area before bouncing back higher. So what I tend to do is look for static support or resistance area, previous one, right? And I try to buy, okay, near that support or resistance area. In this case, if we have a support, static support around there, right, I will try to buy dollar yen near that support or resistance area. Okay? That's one example.